I'm Nicholas of Capital Inc., Nicholas Bornodis. I would like to thank all of you for joining us at this traditional session that is hosted by Fitch Ratings. I'd like to thank Greg for the long partnership we have, for hosting this very interesting panel year after year, and for putting it together with an amazing group of panelists. So with my thanks, I will turn it over to Greg, and I welcome the panelists to the session. Thank you.
Thank you, Nicholas. It's good to be back. As you said, we've done this panel for many years now. I always look forward to it, and we'll cover the leverage profile of closed-end funds. We'll talk about recent trends, how things have changed. Of course, we'll pay particular attention to the stress we've experienced in the first quarter and how that's impacted closed-end funds and their leverage. My name is Greg Fayvilevich. I head up the U.S. funds group at Fitch Ratings. We assign ratings to notes and preferred shares issued by closed-end funds, and we publish research on trends in the sector and regulatory developments. And I'll let the other panelists introduce themselves. John, maybe you want to start?
Okay, I'm John Brown. I'm a managing director at Barings, based down here in Charlotte. Barings is an asset manager with about $350 billion of assets. I'm a member of the private debt group.
Chris?
Hi, so this is Chris Larsen with Franklin Templeton, formerly of Legg Mason, which was recently acquired by Franklin Templeton, senior product manager, responsible for the closed-end business here.
Hey, hello, everyone. It's Amit Jain. I'm a managing director with Nomura Securities International in the financial institutions group, where we cover asset managers on a variety of capital raising and strategic topics. And in particular, we've spent a lot of time recently around opportunities for closed-end funds to access leverage from different sources.
Thank you. All right, so let's dive right in. Okay, so for the first slide, we like to do a bit of an overview of leverage ratios of closed-end funds. Leverage ratio essentially is just the amount of leverage divided by the total market value of the assets. Essentially, we draw a lot of this data from public financials, and one thing I'd like to highlight is that there are some delays in the data. For example, some funds will report October, November, December. So they do this on a semi-annual basis, and that's how we display the data. So most of the data you'll see is as of second half of 2019, and that's just because not all funds reported as of the first half of 2020, which is unfortunate given all that transpired in the first quarter. So we do plan to update the data and publish something in the next couple of weeks once everything is available. So we'll use the data we have as a reference point, and we can talk to some of what we've seen happen in the first quarter. So here on the right side, we see the leverage ratios of all the municipal closed-end funds that we track. These are not all necessarily Fitch rated, some may be unrated. And you can see that leverage ratios cluster kind of in the area around high 30s, low, maybe sometimes low 40s%. On a taxable closed-end fund side, it's much more dispersed. It really depends on the sector and leverage management strategy. I think a lot of what drives the leverage ratios can help managers think about them as risk management. So the reason that municipal bond closed-end funds have typically higher leverage ratios is given the relative stability of municipal bonds versus some of the other asset classes, and we'll see that later in some of the data in the other slides. Besides the risk management perspective, there's of course there are covenants built into fund documentation that would limit leverage, and then of course ratings. From our side, we assess each portfolio and based on the potential volatility of the assets, come up with a rating. Some of those asset coverage tests are built into fund documentation that could also dictate how funds manage their leverage. One additional point I'd like to bring up that's important: Fitch has recently published an exposure draft proposing some fairly material changes to how we look at closed-end fund ratings. We've been, maybe for a little bit of background, we've been rating closed-end funds for maybe about 25 years or more, largely under a similar framework of looking at the assets in the fund and assessing their potential liquidity and stability, and coming up with asset coverage ratios and assessing the funds on that basis. And the reason we're changing or we're proposing to change some of the methodology now is not necessarily directly linked to COVID and what we've seen, though certainly the performance of certain funds during the COVID downturn has solidified some of our thinking around this. As I mentioned, we published an exposure draft, which means we've put forward some proposals for how we would like to change the methodology. And we're looking for market participants to provide comments. This comment period is open through September 21st. So if anybody would like to provide feedback, either supportive or not, we'd appreciate that. And please feel free to reach out. The exposure draft is available on our website. And if you reach out, I'm happy to share that. I won't go through all of the changes, but I'll mention some of the key ones. Really the main change is that, well, historically, we've rated closed-end funds often at the AAA rating level. And that's given the stability we've seen over the many years that we've rated them. We've never recorded a default on a closed-end fund obligation, neither in 2008 nor more recently in the first quarter or in other instances. So that's always supported the high ratings. However, there are certain characteristics of closed-end funds that our thinking has evolved on, and primarily the market value exposure and how quickly the profile of closed-end funds can change. So if you think of AAA rated obligations are meant to be, by definition, the most stable and solid obligations. In a closed-end fund, what we have and we've seen happen more than once, and again, beyond just the COVID-related stress recently, you can have funds that have relatively high degrees of cushion to their asset coverage levels, and then in a matter of weeks or even days, that can get eroded pretty quickly. And so some of those characteristics we deem as not consistent with AAA anymore. We know that other rationale, it's a little bit deeper in the exposure draft. I urge everybody who's interested to read that. But in practice, what this will mean is that primarily the municipal bond closed-end fund that we rate, those that invest in high-grade municipal bonds are likely to be rated in the AA category. Pretty much all other asset classes are likely to be rated as high as single A. So funds that invest in high-yield municipal bonds, high-yield corporates, equities, convertibles, those are likely to be those are capped at single A rating. So you'll see a bit more of bifurcation if the proposals are adopted as currently proposed. So I don't want to spend all our time talking about that, but if anybody would like to have more detail, again, please reach out. I'm happy to do that. On that note, let's go to the next slide. Okay, so what we have here is our kind of traditional slide, just updating the profile of leverage and taxable closed-end funds. Again, this goes through the second half of 2019. We see a bit of a decline in leverage from 2018. That's driven primarily by some of the market volatility we've seen at the end of 2018, which was a fairly small scale relative to the first quarter this year. Yet we've seen some deleveraging at that time. Once we update our data, we expect to see a material decline in leverage. You can see all the way to the left, back in 2008, the magnitude of reduction in leverage, and then in 2014, 15, 16, and driven by the performance of energy-related funds, also some declines in leverage. So I expect 2020 will look closer to 2008 than 2016. So maybe on that note, Chris, turning to you, maybe on the fund manager perspective, could you give us a bit of an overview of how you look at managing leverage targets and like, specifically for taxable closed-end funds and kind of pros and cons of the different leverage forms?
Sure. Thanks, and hello, everyone. So yeah, I think every manager does it a little bit differently. But generally, what we find at our firm is, it's a portfolio manager decision, on leverage and on the leverage amount and on the source of leverage. And each source, as you can see here, there's a number of different options to how you can lever your product. They each come with some pros and cons, right? So if you look at the biggest bucket, which is the bank debt, those are lines of credit which you have access to a certain amount of capital the bank's willing to provide. You can draw it down, and then you can pay it down relatively quickly. But it's typically a committed line, so it's there for you if you need it. And then you have repo, which is something that's a little bit more market driven. So that is one where if the cost is better, managers, in our shop, if the repo market is more advantageous, they'll use some repo and maybe pay the line down to get a better leverage cost. But again, there are market dynamics. So, sometimes the rates will, they'll fluctuate, right? So it's something that we're always aware of. And then at the top, you have kind of the private preferreds and notes. And those are more generally, not always fixed rate. They're a little more permanent in the sense that you really you can't really pay them down anytime you want without a big penalty. And so typically you'll find firms will put a little bit of that on, and then they'll augment it with kind of a line of credit or something else. As far as targets, I think what we would say is managers generally have I would call it a comfort zone of where they would like their leverage ratio to be. And it's not that they're managing it on a day-to-day basis, but, depending on their outlook, they'll either, in our firm, if they feel like it's a really advantageous time to go in and buy securities, they'll increase the leverage. And then when they feel like the market may be a little bit heady, they'll take the leverage down a little bit. And so, not that they'll take it all the way off, because there's obviously a positive carry. And generally, closed ends, as people know, are designed for income. And so we'll use that to kind of increase or decrease the exposure and increase or decrease kind of your, I'll call it risk in a way, to the return. So when we're conservative, we'll take it down. But these are longer term views. So it's not that we are dialing that leverage up and down every day or month, but it's more, if we think there's an opportunity over the next 12 to 18 months, we may increase it, and then we'll run at that rate for a while as that theme plays out. So I'll turn it back to you, Greg.
Thanks, Chris. And John, you as the investor in the notes and preferred shares, you sit on the other side of that. Could you give us your perspective on what are you looking for when you're looking at these securities?
Yeah, I do sit on the other side. In a number of ways. So one, when I'm investing fixed, I'm investing relatively long. And by the other side, it's really the other side of the banks here. So the banks are investing shorter. The bank debt is floating rate. The bank debt can be prepaid without any penalty. And so in times of market stress, the first thing that most managers look to do is take down that bank debt. And I think that's one of the strengths of the structure. In terms of the underwriting analysis and what we're focused on, of course, we're going to be focused on the assets, the quality of the assets, the diversification within that portfolio. But what's equally important for me, and this is a little different from other types of analysis, is the liquidity of those assets. I want to know that if there's a market event, the assets can be sold if needed to right-size the portfolio. We'll talk a bit about structure. One of the benefits of the structure, maximum leverage, is called 33%. Maximum leverage, that's for debt. Maximum leverage overall is 50%. So, overall the portfolios have relatively low leverage. I mentioned in my structures, at least, I'm investing relatively long. Secured, unsecured matters a lot less to me. What matters more is what institutions can get in front of me in my structure. What institutions can prime me? I want to be side by side with that bank debt, with no assets or very few assets carved away from my structure. And then we take comfort from the 40 Act protection, and we'll also have those leverage limits, usually a 300% leverage limit for senior debt, and then it'll go up to that 50% leverage limit. Yes, 300% asset coverage, that is, or 200% asset coverage. It equates to 50% leverage for preferred.
Thanks, John. And Amit, you sit kind of in between Chris and John. Could you give us your perspective?
Absolutely. So thanks, Greg, and hello, everyone. So from the banking side and the origination side, we see that there continues to be appetite across these different structures. At my firm, Nomura, we are certainly involved in pretty much all of these with the exception of the plain bank debt, be it more derivative forms through repo, some of the things that we can do for equity funds on the prime brokerage side, stock loan agreement, et cetera. And then where I focus on is a little bit more akin to John's world, which is helping managers structure and issue privately placed senior notes and preferreds, or MERPs, to those insurance companies like Barings. What I would say is that from my perspective, for some of the reasons Chris mentioned in terms of the interest rate environment and the positive carry that leverage can provide for most of these income-oriented funds, utilizing leverage is certainly a benefit to shareholders over time. And I think it's certainly a way to differentiate the closed-end funds versus the plethora of investment options that investors, retail investors in particular, have at their disposal. So we're big proponents of utilizing leverage. We think that it makes sense to have a structural component to leverage as well as a ability to be tactical. So with that said, a blend of both bank-oriented facilities and bank-oriented kind of flexible leverage that can be toggled up and down, as well as utilizing some preferred shares. We think that that's a optimal blend to provide managers the greatest degree of diversification, greatest degree of flexibility, and allow them to really utilize what the structure is meant for, which is to take on leverage to provide positive carry and the opportunity to maximize total return over time. So we're big proponents of issuers tapping into these markets, specifically as it relates to private placements. Of course, there's a cost disadvantage, or they're more expensive than bank forms, shorter dated, but locking in the term, we think that it, depending upon what the underlying strategy of the fund is, it can be accretive to NAV and accretive to the dividend profile, again, depending upon the asset class. It can be provide the opportunity to add fresh capital and take advantage of opportunities, tactical opportunities in the marketplace. And frankly, the buy and hold investor base that these insurance companies represent, it's a friendly pair of hands. There's governance advantages that we think make closed-end funds that have taken advantage of preferred shares privately placed to insurance companies. We think that they are less susceptible to activist behaviors and activist involvement. So we think there's a good reason and rationale for issuers to be thoughtful, creative around all of these options, and in particular are very bullish on MERPs.
Thanks, Amit. And just before I move forward, forgot to mention, please submit your questions. I already saw a couple of questions come in, so a few of those will be addressed during the presentation, and we'll leave a few minutes for Q&A if we haven't addressed all of them. So feel free to submit throughout the presentation or at the end. Okay, let's move now to the municipal closed-end fund side. They're fairly stable leverage level over the last couple of years. Again, we have seen some deleveraging in the first quarter, but certainly not as much as we've seen on a taxable side. Again, this just goes back to the relatively more stable nature of municipal bonds. We have seen a bit more innovation there over the last couple of years. new types of products being launched. I mean, not necessarily revolutionary, but kind of tweaking some of the existing products to make them as efficient as possible. Chris, back to you if you can give the perspective on the muni side.
Sure. I think, the muni space is honestly a great place to put in very long-term financing if you can get attractive rates. And it goes back to the stability of the assets. And as we all know, in munis, and especially investment grade munis, the default rate is very low. So even if there is some price movement on the bonds, they generally come back up to that par value and will mature out or get refinanced out. So it's a great place to be. After the auction rate market froze in 2008, a couple of new types of preferreds that offer kind of a liquidity backstop came into the market and really replaced the auction rates substantially, that and TOVs.
Okay, thank you. Okay, so now moving more specifically, talk about what we've seen in the first quarter, the dislocation. Here we've compiled NAV declines by sector, peak to trough during that about a month period, mid-February and mid-March. And these are just the Fitch rated funds. Now, from our perspective, during the volatility, we were in very close contact with all the managers, sometimes on the every couple of days, discussing with them on their plans, particularly the ones that are more exposed, like the MLP side. Now, you can see here clearly the MLP or midstream space experienced really huge declines in valuations, much more than we've seen even in 2008. Other sectors relatively look better, but still equities and convertibles kind of average 40% or so down, from an NAV perspective. Recall that's exacerbated by leverage. I think the portfolio values fell less than that. And on the right side, municipals kind of performed kind of the best. As was already mentioned, I think generally what we've seen is fund managers looking to reduce their most flexible form of leverage. So for taxable funds, it would be the reverse repos or bank debt. On municipal funds, that could be TOBs. Chris, maybe going back to you, can you give us your perspective on how funds reacted? And this is not just for MLPs. Actually, maybe best if I turn to the next slide, which is our data point that we did collect for the first half. So that's generally through kind of May or so of this year. So it reflects the downturn, reflects a lot of the deleveraging that happened for the MLP funds. So we can use that as a reference point for some of the other funds where deleveraging happened on a less severe basis. Here in the MLP space, about $4 billion of leverage was reduced, which is quite a lot of assets being put into the market, about 72% of the starting leverage. So Chris, maybe back to you now, if you could speak up either about MLP specifically or some of the other funds.
Sure. So look, earlier in the year, right, during the market meltdown, there was a lot of stress across asset classes, which you can see in the prior slide. MLPs obviously were the hardest hit sector out there. And that's the one that was impacted, obviously the most. So as John had mentioned earlier, there are certain coverage ratios that you're required to maintain across all funds, where if you have senior securities, it's a 300% coverage test, which equates to 33% leverage. And with preferreds, it could be a 200% coverage test, which is 50% leverage. Within the MLP funds, we had a combination of line of credit, notes, and preferreds. And when you look at that market, and I was just looking at some numbers before the call, from January 16th, which was kind of the high in the year, to March 18th, MLPs declined about 69%, and that's using the Larsen MLP index. And if you look at from March 2nd to March 18th, so a little over 2 weeks, in that 2 week period, the Larsen index was down 60%. So you had a very rapid decline. You know, in our funds, we historically have tried to maintain a pretty good downside buffer. So typically it was, you know, 45, 50% downside buffer before you're going to run across your SEC coverage ratios. But obviously in that kind of decline, we were obviously very concerned about hitting those ratios. And, in that situation, we had to raise some cash, and we ended up, paying down some of the notes to bring our coverage ratios back in line. We did have some cash going into it, and we had paid down, and to John's point, we had paid down the line of credit first, because that's the easiest one to do and the least punitive to do. So that's kind of the first quarter. I think across, thinking across our lineup, and we have 25 funds across our different investment managers across all different sectors. The MLPs were the ones that had obviously the most delevering. The rest of the funds were pretty well able to weather the storm. So there really wasn't much of, situations where we were running up against the 40 Act coverage ratios. So I think, having, I guess actively managing your leverage, making sure you have some downside cushion to absorb that volatility in the marketplace is really important, especially in leverage strategies.
Thank you.
And just to dovetail some of what Chris was saying from an investor perspective, what Chris is hinting at is that volatility was really unprecedented in that sector. No one had seen it before, and that includes the global financial crisis. And so, for us, I can say first and foremost, every manager that we had exposure to in that sector did a great job of staying in front of us as investors, and a great job of giving us the information that we needed to continue to make good, reasoned, sound decisions. So not based off of fear, but based off of data. But equally important is information that allowed us to update our clients, because of course we were getting calls, especially the day where oil traded below zero. That was, day with a lot of calls. Well, I was prepared for that because I had calls with at least 3 or 4 managers, and I knew exactly what was going on there and exactly the difference between those trading characteristics and the trading dynamics and the underlying companies, where we looked at several portfolios, and they had, that were predominantly, in some cases, these companies were predominantly natural gas, and that natural gas was needed to heat a Midwesterner's home and make sure they had hot water. Well, we knew those companies would be okay. But at the same time, I'm a debt lender. I'm a lender at the end of the day. I'm not looking to take equity risk. And so it was important that I stayed on top of this in close contact with the managers to understand what the deleveraging strategy would be.
Amit,
the last thing I'll say before turning it over, it really, that environment where you had, again, volatility worse than the global financial crisis. The structure was tested during the global financial crisis. Structure worked. The structure was tested again in March. The structure worked. It's very, very robust.
Amit, maybe your perspective as well.
Yeah, I don't have a lot to add. I think Chris and John made great points, and I would say that again, this unprecedented market conditions, extremely severe downside action in a short, concentrated period of time, and closed-end funds actually, I think, proved their mettle and did quite well in managing through. Sounds like there was good communication between the issuers and the end investors on the private side. So I think overall, despite what was a terrifying environment to live through, I think overall, kudos to the entire community for putting in procedures and structures in place that seem to have held up reasonably well.
And we got one question on this about why did MLP funds kind of stop paying dividends instead of deleveraging? And I guess my answer would be, I think that things just move very quickly, and once you breach asset coverage requirements, you have certain steps you have to take. So stopping a bit dividend payments probably not going to be enough and going to be a bit too late. I don't know if, Chris, you'd agree with that.
Yeah, I guess, yeah, I would say, I know that is an option, right? So if you do breach your asset coverage, you could stop paying a dividend on the common shares until you come back in compliance with it. I think given the nature of the underlying assets and how quickly the market was moving, right? Every time the market would go down, your leverage is now increased that much more, right? And so at some point, you become way, way over leveraged to a point where, we just wouldn't be comfortable doing that. So that's point one. And I think point two is that when you have notes and preferreds outstanding, there are provisions where you could end up in an event of default, right? And if you go below those coverage ratios, you can end up in an event of default, and they can force you to repay the whole entire facility or note or preferred. And so, it was, in our view, it was in the best interest of the investors to bring those or ensure that our coverage ratios were in line because of what the terms in the documents.
Okay. All right. So we have just a few minutes left. So we received a question about costs, and good thing we have a slide on this. So maybe we'll start with the municipal side. Again, recall this is data from kind of prior to COVID, and I think pricing adjusted since then. So it's more a relative perspective and kind of hard sometimes to break by maturities and kind of when the facilities were put in place. But relatively, those are prices that we've seen kind of end of 2019. Chris, could you talk a little about how that got adjusted and where you see right now?
Yeah, I mean, on the muni side, you know what? Honestly, the rates right now, given short-term rates are so low, it's if you're using a VRDP or something like that resets its rate every week or month, right? It's based off SIFMA typically, or short-term reference rate. So those short-term rates are very low, so that cost is pretty low. They do have a liquidity function where it's kind of like having a bank line of credit behind it, so that if they become illiquid, the bank would buy it and take it on their balance sheet. There has been a little bit of pressure on that side to try and, on those rates, but we haven't seen ours really move. So I guess it's kind of situational specific.
Okay. And on the taxable side, again, some of the things is probably more different types of securities here. Maybe John, would you mind talking a little bit about how you price, how you look at these? I believe you invest in notes and preferreds.
Sure. And the caveat is this certainly has moved as well. Again, I'm investing fixed rate, so it absolutely has moved. Both spreads and rates have come in dramatically, or I should say significantly, since the beginning of the year. In terms of how we price, many times we're looking at where other transactions have been done recently in the market. We're also looking at public trading comps, and the public trading comps are difficult to find. And so what we do in terms of kind of a back-end kind of way is look at high-quality banks and asset managers. I'll choose BlackRock as an example. And let's just say, all right, well, where is their debt trading in the market? And then we'll add a premium to that, a premium anywhere from a low of 25 to a high of, call it 70 basis points. In terms of, and then the nuance to that is, as you get into the lower quality portfolios, and I'll define low quality here, less as debt versus equity, but that's certainly a component of it. So investment grade equity is going to trade tighter and the rate will be lower. I'm sorry, investment grade debt will be lower and will trade tighter than, let's say, equity. But component is the liquidity of the underlying assets that I mentioned earlier. When you start adding more illiquid assets, the extreme being, let's take BDCs, the rate is totally different. So I'll leave BDCs out of this conversation. What I'm driving towards is for a liquid portfolio on the senior debt side. If I saw a 4 today, I'd fall off my seat with excitement. I don't think we're going to see many 4s in this market. Instead, I think we're somewhere around 2.8 to 3% on a yield basis.
Thank you. And I think we have getting some echo there. I think we have 2 minutes left. So maybe if we could spend 1 minute, and do you feel after the dislocation we've seen in the first quarter, the investors still have demand for these type of securities? Is it in certain sectors? And how do you feel about this?
Yes, absolutely. Just to round out the point on pricing, anything on the taxable side that's linked to a short-term rate, so floating rate, repo, bank facilities, those are all, again, significantly changed from what's displayed on this page as LIBOR has gone to 0 and seems like it will be stuck there for quite some time. So we're looking at, call it 150, 200 basis points below what's been displayed here. So it obviously accrues to the benefit of an issuer right now to take advantage. We definitely are seeing appetite and demand from on the private placement side as well. We've spoken to, of course, there's probably a cohort of maybe a dozen or so regular investors in terms of insurance companies that have gotten comfortable with the 40 Act structure, that have participated in deals, that have gotten their committees to fully understand the nuances of 40 Act regulations and the various covenants. We've been in discussion with about a half dozen other potential investors that we think will help to create improved pricing for issuers as more investors start to look at this structure, understand it, and again, it's a yield-starved environment for the insurance companies as well. They're looking for creative ways to put their capital to work, and when you look at the default history and really kind of what we think is relatively strong credits in terms of how closed-end funds are structured, we think that there will be continued new interest. We're seeing it already. So we do expect that's a positive trend for issuers and shareholders.
Okay, thank you. Last slide I'm going to hit. This is our traditional annual bank league tables on the taxable side. You can see the changes on the right side. I'm going to stop sharing now so we can get any last question, and I think we're pretty much out of time. But I will note we have seen some changes in the counterparties recently. Some banks are getting out of this more on a municipal side, but after the 08 crisis, we've also seen some counterparties leave the market, and so and others have come in. So we'll see how this develops. Guys, any last questions or last points you'd like to add? No? Okay. I think we're pretty much out of time. Oh, I'm told we have 2 minutes left. So there was one additional question. I think somebody mentioned, the IPO market, and we've seen inclusion of some more illiquid assets, and the IPO market gets more creative. How does that impact the appetite for leverage and the type of leverage?
Yeah, I guess I'll answer that. We haven't been in the market with anything new this year, but just from our product lineup and working with banks. Yeah, the market has been creative. I would say, the bank lending is really dependent on the underlying assets. So for a line of credit, for example, if there are illiquid privates, you're really not going to get much credit for those, at least in my experience, just because, what their concern is access to liquidity if they need it. And so, could it impact it? Maybe. But when you think about from a bank's perspective, when they're lending to all different types of companies and entities, the 40 Act protection with the 300% coverage ratio is pretty attractive, right? So it gives them pretty big buffer around potential losses. And so I don't think it should have that big of an impact. I mean, unless you have a portfolio of 100% of liquids or something like that.
Yeah, just to add to that, you are seeing even the fixed rate structures evolve to allow for some of it in a very limited way. So a 5% bucket, a 10% bucket, a 15% bucket. The reality is for a lot of equity managers, they've noticed that you have a lot of companies, a lot of venture companies are staying private much longer. A lot of companies that aren't public and still called venture are only called venture in name, in terms of their size, the fact that they've got strong business models, and their private investor base at that point, they're already at the point where they would be a mega cap company. In order to have access to the full universe of opportunities, you're seeing equity managers have to dip into some of those pre-IPO, late-stage venture companies. And the structure, again, has evolved to allow for some of that, but again, keeping it relatively limited.
Thank you. So I think we could probably talk about this for a while longer. I think there's a lot of interesting things to say, but fortunately our time is up. And so I'd like to thank our panelists very much for joining, providing their insights. If anybody's interested in the slides, please feel free to reach out and we'll be happy to share them. And so until I guess next year or a couple of months from now, have a good day. Bye.
Thank you.
Thank you, everyone.
Thank you.
Thanks.